Hello, and welcome to PubK's 2023 Government Contracts Annual Review. We're thrilled to have almost 4,000 registrants for this entire program. Over today and the next two afternoons, we will present 8 additional sessions. We hope you'll be able to join us for most, if not all, of these sessions, but a separate registration is required for each session that you want to attend, which you can do so at the PubK website under the Annual Review tab. My name is Alan Schwatkin. I'm the president of the PubK Group and a partner in the law firm Nichols Lew. I'll be your host, facilitator, and moderator for this year's annual review. The PubK Group publishes 4 newsletters: PubK Law, PubK Compliance, PubK Cyber, and our newest that was launched in mid-2022, PubK M&A. Many of you are already subscribers to one or more of these publications, and we very much appreciate your support. Some of you who are joining this annual review are not yet subscribers. Well, I hope you'd consider becoming a subscriber. Information is at the website shown on this slide or is available from any of the contacts you have at the PubK Group. This conference would not have been possible without the strong support of our event sponsors, all of whom are listed on the next 2 slides. I encourage you to look at their skills and capabilities these firms have and engage them as you see fit. Also new in 2022, PubK joined with Arnold & Porter to launch a periodic podcast called Bonafide Needs, covering emerging issues and interesting interviews. We'll continue that in 2023 as well and encourage you to access them through our website. If you're interested in partnering with PubK on a podcast, we'd be pleased to discuss this opportunity with you. In lieu of speaker gifts and in honor of our sponsors, PubK is making a contribution to the Capital Area Food Bank. With the food crisis facing our communities, including the military, and yes, here in the Washington, D.C. metropolitan area, I hope you'll consider making an individual or an organizational contribution. Since the entire program is being held virtually, all attendees will be in a listen-only mode. Your video will remain disabled throughout the session. But we welcome your questions. Use the Q&A box at the bottom of your screen. However, with so many attendees, it will not be possible to answer all of the questions in real time. We are capturing your questions and will endeavor to answer as many as possible at the conclusion of the annual review. All presentation slides will be available for download now from the PubK Group, presentation slides for this panel, and all presentation slides along with the audio recording will be available for download probably within a week or so of the conclusion of the full annual review. We'll send an email when this information is available for download, how to access it, and for how long the material will be available. We're also applying for continuing legal education approval in Virginia, California, Texas, Florida, Colorado, and Kansas. We just got California this morning, as a matter of fact. While we cannot guarantee approval in the other states, we expect that acceptance within the next few weeks. Again, we'll notify all attendees when those approvals have been received. So if you're interested in obtaining CLE, please register for that information on the website and look for our poll questions. We'll have 2 of them during this presentation. The state boards require us to verify your participation during the event. We'll keep track of your response to verify that you viewed the panel. But if you don't wish to obtain CLE credit, you can disregard the poll or just give us an answer for fun. Now I'm thrilled to kick off day 2 of this 8th PubK annual review with our session 4 panel on cost, pricing, and audits. I'm pleased to welcome our newest distinguished member of the panel, Laura Semple of Amentum, and also welcome back our returning members, Greg Bingham from HKA, Joe McCaffrey from Baker Tilly, and Ryan Bird from Berkeley Research Group. Laura, over to you.
Sure, thanks very much, Alan. Hi, everyone. My name is Laura Semple. I am the Assistant General Counsel at Amentum. Specifically in that group, I'm the lead business counsel for our intelligence and our engineering, science, and technology group. Prior in a former life, prior to the good days of Amentum, I was an associate over at Smith Pachter McWhorter, where my practice focused on cost and pricing issues.
I am Joe McCaffrey, and I'm a partner with Baker Tilly. I focus on cost and pricing issues for government contractors, both in the for-profit space and in the not-for-profit space as well. So regularly dealing with DCAA audit issues, incurred cost submission proposals, CAS disclosure statements, and all the other fun stuff in those areas. Looking forward to the discussion today. And I think Ryan is up next.
Ryan Bird with BRG and our government contracts and grants advisory services practice. Our practice helps for-profits and not-for-profits receiving federal funding throughout the contract lifecycle, from pre-award, post-award, involved in business system reviews, claims, terminations, disputes, bid protests, all the way through closeouts.
Thank you. And so I'll go next. This is Greg Bingham. I'm an HKA partner and co-lead of our government contracts group. I've been working on government contract issues, many of the same things that have been listed thus far. Often these days it's expert witness testimony and disputes, or assisting companies in complying with the regulations, or investigating fraud, forensic accounting, things of that nature. And so I think that's it with the introductions. And so I just wanted the agenda is up in front of you now, so you can see the different topics we're planning to cover. We're going to emphasize the DCAA activity and audit guidance, the significant legal decisions, and then how to deal with the current inflationary environment. But we're going to cover all of these areas. And with that, if we go to the next slide, I'm going to turn it over to, and the very next slide, turn it over to Joe. Joe?
Yeah, thanks, Greg. So we'll start off with a little discussion about DCAA, what they've been up to in calendar year 2020 based on some of the reports that they've sent out. But first, there's been a number of leadership changes at DCAA this year. So initially, Anita Bales retired in early January 2022. She had been the director of DCAA for about 7 years now, and she retired. She was replaced on an acting basis by Deputy Director Joe Bentz, who most recently also retired at the end of December here. And a new director, Terry Dilley, was appointed about halfway through the year. And interestingly, from a background perspective, so both Anita Bales and Joe Bentz had previously been with the Army Audit Agency before they joined DCAA. Terry, on the other hand, comes from the Air Force, so it'll be interesting to see from a leadership and direction perspective, what, if anything, Terry emphasizes and focuses on in the next few years, but we'll at least discuss, based on their recent report to Congress, what they were reporting on earlier in the year. From a guidance perspective, DCAA on their website publishes a few different pieces of information. So one of those is what's referred to as MRD, so memorandums for regional directors. And they are kind of flash reports of new or emerging issues that auditors need to be aware of. And continuing the recent trend, there were only 2 MRDs that were published this year, and honestly, they were pretty inconsequential, more on kind of administrative items and maybe not of interest generally to contractors. In the past few years, there had been some MRDs published on COVID guidance. Ryan will go over a little bit of that later. But this is really continuing the trend from a DCAA perspective of having less and less public-facing guidance for contractors to understand what the audit agency is doing, how they're conducting audits, and what their expectations of contractors are. Because one of the other pieces of information or manuals that they have out there is the DCAM, or the DCAA audit manual. And that has continued to go through rewrites over the past handful of years, where DCAA has slowly taken out pieces of guidance and information that used to be in there and are now making it more generic, tying more to regulation, which in general is good, but stripping out some of those expectations that were, good as a reference point for contractors to have. And from conversations with people in DCAA, those pieces of information that used to be in the manual are now in internal guidance that's still available for auditors, but not necessarily available for you and I to go out and find on the website.
And I'll just comment, if this is a good time, Joe, just like over the course of my career, I've seen, there was a time when the DCA audit programs, for example, were just not available in the public domain. If you got them, it was through discovery and a dispute, that sort of thing. And then it became where those audit programs were available online. And so there was a common point of negotiation or a common point of what would be done in accordance with audit programs, because the contractor had the same audit program that the auditor had. And in fact, recently I was kind of negotiating with the DCA over what is the right audit program to use for a particular contractor and a particular type of accounting system that they were going to be reviewing. And so I wouldn't be surprised if fast forward 5, maybe 10 years, that sort of commonality between the oversight community and the contractor may not be there anymore, because they're just the guidance documents of the DCAA that have historically, or the last 15 years or so, been very available to the contractor community, I think are being less so. So these audit programs, are they going to go away entirely? I don't think so, but like what currently might be a 19-page audit program might become a 5-page audit program, with a lot of the meat of the audit steps being moved to internal guidance.
Yeah, and again, continuing trend on that part. And in our prep session, Ryan asked an interesting question. Is there any correlation between public-facing guidance and what audit expectations are and DCAA's peer review? So as an audit agency issuing opinions, DCAA is subject to a peer review of quality of their audits. And historically, the DoD IG has done those peer reviews. And while DCAA has passed in prior years, they frequently passed with deficiencies or issues that were noted that could be improved upon. In the most recent calendar year, DCAA's peer review was done by a third-party public accounting firm. And for the first time in my memory, that peer review came back with no deficiencies, no recommendations, and a clean bill of health. So I will leave it up to you, the audience, and unless one of the panel members wants to chime in on whether that's a coincidence or cause and effect.
And I'm just restating kind of, but just if you make the criteria against which you're measured, if you make those criteria easier and easier, then yeah, you're gonna be found acceptable. You're more likely to be found acceptable. I tend to think it's not by design, that it is just, so I work in the dispute field a lot, and so literal disputes, ASPCA or a court of federal claims or some kind of state and local court, or disagreements with the DCAA. And so I like the ability to be able to point the DCAA to particular passages in their guidance. And they may well not like that. They may well not like auditors being deposed and being shown passages from their audit program and say, how did you deal with this? And so that, from a dispute perspective, I can see why the government oversight personnel may prefer to have less of their guidance in the public domain.
And if we could flip to the next slide, we'll talk about what DCAA has been focusing on. And so on an annual basis, and Bill, if you could flip the slide, DCAA is required to report to Congress the results of what they've been working on. And so in the chart here is a year-over-year comparison of where DCAA has been spending their time. And so I'll step through it a little bit and then give a little commentary. So along the bottom, there's different focus areas or different groups of types of audits. So on the left-hand side of the screen, forward pricing audits. So those include proposals that are submitted by contractors or forward pricing rate proposals for indirect rates, but it's generally forward-looking information. The second set is for incurred cost proposals, so required for contractors that do cost reimbursement contracting. And again, that's where a lot of historically audit activity had been. The third area is for claims and terminations, which we'll talk about trends there in a little bit, but again, how many claims and terminations DCAA is reviewing and how much time they're spending doing that. And then the last area is business systems, TINA, and CAS audits. And so we'll focus on the incurred cost first, and continuing the trend that we talked about last year, DCAA has generally caught up on that large backlog that they had. So typically now, DCAA is coming in and auditing a fairly recent year of incurred cost audit activity at a contractor, or based on their audit guidance, not doing an audit because that contractor has been determined to be low risk and the ICP hasn't been sampled. So again, year over year, the number of audit reports being issued is lower and lower. So about 1,100 in FY19 to now 594 for fiscal year 21. And the number of audit hours that they're spending in those areas is decreasing as well. On the far right-hand side of the chart, though, this is where DCAA is shifting some of their focus. And that's in doing more business system audits, more TINA audits, and more cost accounting standards audits. And so the number of audit reports has climbed from about 300 to about 592, almost doubled in 2 years. And the number of hours, the internal cost of those hours keeps climbing as well. And, you know, anecdotally, this matches what I'm seeing at clients and at contractors. DCA is typically up to date on incurred cost submission audits, and those continue as fairly routine. But now contractors are seeing more cost accounting standard audits kicked off, and more business system audits regularly kicked off and completed.
And before you move on, before you move on, I'll just say in the far right where it's got business systems, TINA, and CAS, you know, what are the companies that that are subject to the business systems, the DFARS business systems rules, and what are the companies that are subject to CAS? There tend to be the more significant government contractors with doing some cost reimbursement work. So there's more emphasis in that area.
Yeah, and Bill, if you flip to the next slide, we'll talk about then the areas where DCA is, you know, finding costs to be questioned and what DCMA is doing with those. So again, a decent number of numbers on the chart here, but running down the left-hand side again are areas that DCAA is reporting their metrics on. So forward pricing rate audits, incurred cost audits, claims and terminations, and then the miscellaneous bucket, so business systems, cost accounting standards, and TINA audits. And in each of those areas, I'm showing the trend over the past 5 years for the number of audit reports that have been issued by DCAA in that area, the number of dollars that they're auditing at the contractor in a given area, and then the sustention rate. And what's a sustention rate? That is if DCAA is auditing a proposal for $10 million, they question $2 million. So $2 million is the amount of question cost. That gets turned over to DCMA. If DCMA agrees with only $1 million out of the $2 million in that audit report, that's a 50% sustention rate. If they agreed to $2 million of the $2 million, that's a 100% sustention rate. So that's just based on the agency view there. And, again, overall, to me, what's interesting here is, you see the trend in incurred cost audit reports and audit dollars is kind of leveling off. The incurred cost sustention rate has also been fairly level over the past few years. So about 29.5% in FY19, up to 30.8% now in FY21. So fairly consistent over the past at least 3 years there. The area though where sustention rate is fluctuating more and the audited dollars are fluctuating more is down in that CAS and TNN business system audit area. Now for business systems, there's not necessarily going to be a question cost, like you have an internal control deficiency, how does that directly relate to a question cost? That's not how those audit reports are structured. But on the TINA side, there's definite question cost, and especially on the cost accounting side, if there's allegations of non-compliance or audits of cost impact proposals related to cost accounting practice changes, there can be real dollars associated with those for contractors and for the government. And so from a focus area, makes sense to me that DCA is spending time there, and DCMA is agreeing with those in large part, about 55% of the time in the past year here. So again, just turn it over to the panel for a minute or two. Does this kind of trend with what you're seeing at your clients or what you're experiencing?
And I'll comment if y'all can hear me. Yes, this does trend with what I'm seeing, and it seems like go after the big dollar matters, emphasizing more audits in the big dollar areas, and then in TINA, and we all know, a now retired Undersecretary of Defense for pricing issues, has said that he thought 1% of DoD spending was defectively priced. And that was like, where that number came from, who knows? But it did get a lot of people's attention, and it caused there to be a significant increase in defective pricing audits that we're seeing the result of here, or we're seeing it reflected in these numbers. I'll just comment while I'm speaking, just on the sustention rate, just to make sure everybody knows, that's where the contracting officer agreed with the auditor. And sometimes, in my opinion or my experience, the contracting officer says, these are my accounting advisors. The DCA are my accounting advisors, and they know cost accounting standards, highly technical area, business systems, highly technical area. They know that better than I do, so I'm going to defer to their opinion. So that probably results in some of the sustaining the DCA's opinion. That does not mean that a judge that has agreed with that, like in a dispute. That just means at the contracting officer level.
And I think the other thing to point out on the sustention rates overall is, just because you have a DCA audit report in front of you that questions $1 million of cost, on average, the government is not recovering $1 million of cost from those audit reports. And based on prior DCAA peer reviews and issues with DCAA, you need to hold DCAA accountable and then point out to the DCMA or whoever the user of that report is, where you disagree again with what DCAA found, where it may not have been a reasonable position that they took from a negotiation standpoint, even if it is maybe from an audit standpoint. Because overall in incurred cost, their DCMA is only sustaining right now 30% of those question costs, so about 30 cents on the dollar.
The other thing I'll add, Joe, is that this is DCA, it's kind of DoD centric. Across the other civilian agencies, we still see significant activity with regards to incurred costs audits by third-party auditors for agencies. still a lot of work with regards to termination settlement proposals, as well as a lot of agencies catching up on CAS audit, disclosure statement revisions, and cost accounting changes.
Yeah, I agree. And before we talk about one of the civilian agencies in particular, is on the business system side here, I continue to see DCAA come through on their promise to do more business system audits at contractors. And typically that's either accounting system audits that they're doing or estimating system audits at most of the contractors. Material management isn't as applicable at a lot of contractors, although at major manufacturers it's very important. But DCAA is doing those audits, they're kicking them off. And now from a trend perspective, I see them completing those fairly timely. So, typically within a year, they will kick off the audit, do the field work, and have a report issued out by the end of the year. Whether you agree with those results as a company or not is a different matter. But they are actually doing them and trying to work through those in a fairly timely manner. So from a contractor perspective, though, if you have a significant volume of cost reimbursement contracts or fixed price contracts subject to TINA, so you would be subject to either an accounting system or estimating system review, and you have not had an audit yet, I would expect DCAA to come knocking at some point. So make sure that you're doing all the prep work in advance to make sure that goes as smoothly as possible. Mm-hmm. So I think the last,
before you move on, you just commented about the time it takes from when they kick off the audit to when they issue the audit report, and it just reminds me that kind of a best practice that I'm seeing over and over is look at the data being requested by the auditors and try to understand what their findings are going to be before you get the audit report, before you get to the exit conference and the audit report. And remember that you have the opportunity that they have a section of the audit report called contractor's reaction. And so you will get the opportunity. You might only have a week or 10 days to provide the contractor's reaction, but once they tell you what their preliminary findings are, you can author something from a few paragraphs to a 100-page report that they attach to their audit report. But then when someone is reading, contracting officer, et cetera, is reading the audit report, they're seeing the contractor's reaction, at the same time. So just, I think that's a good thing to take advantage of. And I just wanted to highlight that point. Back to you, Joe.
Yeah, so if we flip over to the next slide to just wrap the overall discussion on DCAA. So in their report to Congress, they report on what their focus areas are, and we have a number of them up here on the screen. So from an audit approach perspective, DCAA is still trying to manage their workload between forward pricing, which need to be done on a timely basis, incurred cost submissions, which they now have a statutory requirement to complete those audits within 1 year, and then use risk and materiality to kind of balance their own workload. They also continue reaching out to their customers and buying commands to understand what their audit needs are to try to balance that, the audits that they are completing to make sure that they're useful. They continue to focus on OTAs and expanding audit rights there. And so overall OTA usage has really exploded in DoD in recent years. And those were designed to have, in many instances, less audit rights or less onerous requirements. But from a cost perspective and the government's perspective, there's maybe even more risk associated with those. So seeing increased audit rights being put into those agreements, and I don't know, Laura or Ryan, if you want to comment on experience there.
For sure, yeah. Just on this piece, I think what was interesting coming out of the report was at least DCAA claims that they had in the past year about 250 asks or inquiries from various agencies asking for assistance with drafting sort of maybe provisions in OTAs that relate to some audit access rights. And DCAA further stated that they are actually in the process of sort of drafting potential language that could go into OTAs. And we are certainly seeing it on our side. We're seeing more sort of audit right expansion, or at least it's, there's language in these OTAs coming out that sort of reflect this as definitely a focal point. So in terms of, practice point, that is something to read for, because we are seeing an increased usage of that audit rights language, filtering their way into some of these OTAs.
Yeah, so
that's consistent with what we're seeing. I mean, almost every OTA that we see has an audit right. We typically don't see agencies exercise those audit rights yet. That may change in the next year or two. But there's so much leeway afforded on OTAs to the drafter that almost every OTA we see has different language. And so it's very contract specific.
Yeah, so again, read the contract and make sure you understand what you're signing up for before you sign the contract. I think the other one we'll discuss a little here is contractor information surveys. So this is a tool or template that DCAA has said that they're using to assess risk at contractors where they may not have as much visibility into, because they're smaller contractors. They have not had a lot of historical audit experience there as well. And so I definitely have seen DCAA send these to a lot of my clients to be filled out. They are typically asking risk assessment type questions. So what types of contracts do you have? Who is that funding coming from? What types of systems do you have in place? What types of internal controls in those systems do you have in place? And so on balance, not an unreasonable ask. But I have seen them also sent to large contractors that have significant DCAA audit experience and have DCAA and DCMA ongoing, doing monitoring. So it seems like there's been some wires crossed on the DCAA side about who they're sending these out to and what they mean.
Yeah, and just on that real quick, if from some other industry events and some of our partners that we've worked with, especially sort of on the small, sort of the lower risk companies, or those that have been identified as low risk, we've heard that sometimes the surveys are also going to multiple individuals within the same company. So one just practice point might be just also sort of identifying one person that is going to answer these, especially if maybe you don't have necessarily a designated or a dedicated compliance department, but you've got a finance team member who's sort of identified as the person to answer the survey when it comes in, just so that you're not having inconsistent survey results going back for your company.
And I would take it seriously if I got one of these, because they're being used for risk assessment purposes. So you don't want to unreasonably or unjustly call attention to the company that causes DCAA to show up at the door as well. So we'll talk a little bit more about PPP and COVID funding in a little bit, but if we flip to the last slide on the civilian agency side, one agency we wanted to highlight was Department of Energy. And 2022 was the year where DOE implemented a change to their monitoring approach for M&O contractors. And historically, DOE was relying on contractors' internal audit departments to perform audits of incurred cost and give the government comfort that unallowable costs weren't being charged to those contracts and passed back to us taxpayers. There'd been increased skepticism, though, from DOE IG about the effectiveness of that role from internal audit. There have been a number of IG reports over the years that called into question that approach, and then whether, even if there were audits, which there were, was the management at a contractor taking those results seriously and implementing corrective actions to prevent, future control failures or things that were identified. So there was a two-part change to the oversight activity. So one was a shift from a reporting perspective and what was reported. So historically, a statement of cost incurred and claimed was used, and now they're asking contractors to complete an incurred cost submission, like DoD contractors or is common otherwise in civilian agencies. And the prior reporting was very high level and had been in place for a number of years. So this shift caused, a good amount of work at companies to figure out how to pull these reports together, make sure that it was in a format that DOE understood and understood all the nuances. And I think in my experience, DOE was pretty cooperative in that process, gave a lot of good guidance and worked as a partner. But now comes the fun part for a lot of contractors, where instead of having their own internal audit department review those, now third-party auditors are coming in to perform audits of those, or DCAA or the DOE IG, depending on who's been assigned. And from that perspective, especially where I've seen third-party auditors, the results are a little mixed in terms of, audit results for the organizations. And so it's good, again, to set expectations up front about controls, how the company operates, background and risk, because again, for a lot of these organizations, it's one contract that they're operating. So even though they may have very complex cost accounting structures and indirect rate structures, ultimately it's all one contract that's being charged to by the government, or I'm sorry, by the contractor. And then lastly, in this area, the IG has, rapidly expanded their own internal hiring a lot of ex-DCAA folks. And they're saying they eventually want to in-house all these audits. So stop relying on third-party auditors, stop relying on DCAA. So I know a number of contractors have had initial audit reports issued. And I expect that trend to, probably increase in calendar year 23 here as well. So again, a set of contractors with different expectations. I would expect some, at least informal disputes, if not claims, being brought over some of these audit reports eventually.
Yeah, and I'll just comment. A summarizing point that the DOE IG is becoming much more aggressive in my what I see and hear than has been the case in the past several years. And they commented that they will be using data analytics extensively without really defining that term, but I think of forensic accounting as in data analytics kind of in the same sentence often. But the other panelists can comment if they feel differently or the same, but that's my impression of what's happening here.
Yeah, I'd agree. Yeah, the IG, she said, focus on data analytics, focus on dollars, and that, a continued large focus from DOE on time charging and potential labor fraud. There have been issues at certain M&O contractors in the past, and that's definitely an area that's on their radar to try to use analytics based on what I've heard. So Ryan, do you want to talk a little bit about trends and guidance for what we're seeing from the COVID-19 and some of the relief and stimulus funds?
Yeah, absolutely. Next slide, please. Okay. Throughout COVID, there were a number of programs that provided aid and relief to businesses, including contractors. Those programs have expired. However, the contractors are now dealing with audit issues related to the credits that have to be processed through the systems and either charged back to the programs or allocated through the indirect rates. And so we're seeing most of these issues arise through incurred cost audits. And the differences in how you would account for things from a financial reporting perspective. So transactions may be recorded appropriately on the face of the financials, but not necessarily in the indirect rates or truing up billings. And so the major sections that were used by contractors included the paid leave reimbursement, the Paycheck Protection Program, the Employee Retention Credit, and payroll taxes deferral. Again, all of these programs expired in 2021. From a Section 3610 perspective, this allowed contracting officers the discretion to reimburse paid leave, including sick leave, to maintain the workforce in a ready state. It also could be used to keep subcontractors in a ready state. And so the contractors needed to identify and segregate these costs in their systems appropriately. The one thing to consider here, under the CARES Act, employees did not have to be laid off or furloughed to collect unemployment. So it's important that under Section 3610, you understand if they were collecting unemployment, and you can't double dip with the 3610 paid leave program as well. From a paycheck protection program, this provided direct incentives to small businesses to keep employees again on the payroll. And then you were eligible for potentially 2 loans under the program. The loans could be forgiven if they were spent on eligible expenses, which included payroll, interest on mortgage, rent, utilities. The one caveat with PPP was that at least 60% of the forgiven amount had to be used for payroll. So large contractors weren't impacted here, but many of the smaller subs did participate within PPP. And then the employee retention credit, it's a fully refundable tax credit for employers equal to a percentage of qualified wages against the employer's share of Social Security taxes. And the interesting thing here is with this program, it has expired. However, businesses can do a look back and modify their tax returns up until April 15th, 2024. So I think the credit issue with regards to ERCs will continue, out into, 2025 from an incurred cost submission audit perspective. Next slide. As Joe mentioned, there was guidance issued, MRDs by the DCAA 20-PIC-006R. It was revised. That was in April of 2021. And that provided guidance when planning and conducting incurred cost audits, as well as forward pricing rates audits. And so I think the best practices here for contractors are to capture Section 3610 paid leave costs to a specific account. If you didn't do that, go back and try to determine what those costs were and segregate them. The cost could also be allocated to contracts on some reasonable basis or potentially through your indirect rates, depending upon your disclosed cost accounting practices. And again, here, I think you need to verify, prior to the audit, were any of your employees also collecting unemployment, even if they weren't terminated? It's critical to ensure there's no double dipping with regards to that program. Next slide. PPP loan forgiveness. So the credits that are received as a result of the loan forgiveness are recorded as income on the financial statements, but in accordance with FAR 31201-1, composition of total costs, and FAR 31201-5, the credits principal contractors, they can claim the costs in the year they were incurred. So if you incurred costs in year 1, but weren't granted forgiveness on that loan until year 2, you're claiming them and you're having to credit back the following year when you do receive forgiveness. Examples of what may happen there: you incurred funds that were spent for rent in year 1. Year 2, you received forgiveness. Was that rent charged directly to a project? Was it charged to facility service center? Was it charged to G&A or overhead? And you would need to credit back the location the rent was originally recorded. With regards to PPP forgiveness, if the costs that were used to justify forgiveness were on commercial efforts, there's no reason to credit the government back for those costs. So just kind of one thing, there was some strategy involved in looking at how you supported the forgiveness of the loans and met the requirements of the PPP plan. Okay. Next slide. Okay, so The auditors, they've issued a lot of guidance with regards to incurred cost submissions. And Joe or someone else, if you want to chime in here, but what we're seeing with regards to the subsequent credits, there's specific questions and documentation that the auditors are looking for. What was your original submission for forgiveness? What were the costs that you incurred? Where were they charged? How are you preparing the incurred cost submission? What were your policies and procedures prior to the pandemic compared to during the pandemic? How did they change? And so they're using that information to ensure you're complying with internal policies and procedures, but also as a roadmap. Did you have any communication with the contracting officer with regards to representations? All of that's trying to get to, have you overstated your indirect rates on those incurred cost submissions? And for many organizations, PPP loan forgiveness was in the millions of dollars, both for the first loan and the second loan. So it can have significant impact on an organization's not only direct billings, but indirect cost rates overall at the project level.
Yeah, so I continue to see or get questions from contractors, although not as much as maybe earlier in the year, especially. But Ryan, you highlighted timing of credits in one of the other slides, and that continues to be an area that I think both sides, contractors and the government, have questions on, especially because from what I've seen, sometimes the financial statement and GAAP accounting for some of those is a little different as well. So again, trying to help companies translate between what's showing on a financial statement that DCAA may also be looking at compared to what's in the incurred cost submission, trying to provide that bridge and explanation for what's going on there too. I've seen questions about that.
Next slide.
And I'm going to interrupt just for 1 second here. We're going to run our first poll for the CLEs. So if you are interested in earning CLEs for this session, please answer the poll that should have just popped up on your screen. And we'll leave that up for about 2 minutes, and I will turn the time back over to the panel. Thank you.
The only other thing I'll mention with regards to this section is really forward pricing rates audits. A significant amount has changed to how businesses operate. Teleworking, downsizing, facilities, closing facilities. And so what we're seeing from a forward pricing rate audit perspective is that historically many of those assumptions were based on historical spend are no longer representative of future spend. So I think it's important for contractors to look at those estimating assumptions from a forecasting perspective and ensure that those estimates are valid. So with that, I'll turn it over to Laura.
Thanks very much, Ryan. Thanks, everyone. And we gave the lawyer a set time frame to try to get through 7 to 8 cases. I'm going to do my best. Hopefully it's not too painful for everybody, but we got a number of interesting legal decisions coming out sort of this year, in 2022, and I will take one brief mea culpa right up on front. I'm going to take you back to just the end of 2021 first, and then we're actually going to conclude this section in 2023. So we're spanning a couple of years, but I think all the cases are important to cover. The first one here, CMI, the contractor, pursuant to its very typical government contracting requirements, submitted its incurred cost proposal. And in that ICP, it included certain costs for a consultant, the consultant fees associated with that consultant. As a little side note, this consultant himself, was actually a member of the board of directors for CMI and was one of the majority shareholders for CMI. Not necessarily something that influences the case, but it is, a circumstance where there might be some additional attention paid to any of the fees associated with, an individual in that position. But overall, the contracting officer in this case, issued a contracting officer's final decision disallowing those claim costs, specifically because, as up on the slide here, CMI, allegedly lacked sufficient evidence of the nature and scope of the services furnished, such that incurrence, allowability, and allocability of these costs could be determined. The contracting officer then, unilaterally set final indirect rates for CMI for that year. So, on appeal to the ASBCA, the Armed Services Board of Contract Appeals, CMI produced promissory notes as evidence that these are costs incurred. We actually had a duty to pay these. Specifically, those promissory notes required CMI to pay the consultant within 5 days of the consulting demanding payment under those promissory notes. The problem being here, in 9 years since those promissory notes had been issued and signed, the consultant had actually never demanded payment on any of those notes. So this had been continuing for about a 9-year period. So really, at the ASBCA level, the question is just sort of, when is the cost incurred for purposes of, actually having to make payment on some of these different types of fees? And here, when the ASBCA took a look, they noted that the CMI contracts contain the allowable cost and payment clause, FAR 52-216-7. And the allowable cost and payment clause speaks in terms of, actual cost, experienced by the contractor. So the ASBCA took a look at a very long line of Federal Circuit case law on when is an actual cost incurred for these purposes. And they really noted in there that the case law notes that contractors must have a legal obligation to pay. That is a rejection of a government argument that the contractor had to have actually paid something. There must have been some sort of actual payment of an amount. But really, what the board and the courts have held is that there needs to be some sort of a legal obligation to pay. And here, the board noted that while CMI had, executed the promissory note, the consultant had never really demanded payment, so there was not that same legal obligation to pay. And I think another important point that ASBCA noted that, there can be an instance where there's sort of this near certain future prospect of having to pay an amount. But here, it can't just be that the future expense must be more than likely or probable to be an incurred cost. It can't just be sort of an unknown sort of future event, as in here, where there may be a demand on the promissory note at some point. So that's sort of the first case. I'll pause if any of my fellow panelists have thoughts on that.
Right. Thank you, Laura, for that opportunity. And yeah, I love the case in that it's talking about this cost being incurred, and you can incur a liability, and that's something that is often confusing. And then focused on, is there a real obligation to pay? And I see that in terminations from time to time, where it's like a company, a subcontractor, say, is asking for severance for an employee, and do they have a real obligation to pay? Sometimes that's in question. It's like, well, if you pay me, I will pay them, but it's kind of discretionary. If they recover it from the government or from the prime contractor, then they will pay the severance to the employee. But that's not arguably that's not a real obligation to pay. So anyway, that's my only comment. Thank you.
No, and it's kind of falls in the long line of sort of quite a few kind of Federal Circuit decisions in this area, just because there's nothing, the FAR speaks in terms of what might be an actual cost, but doesn't necessarily speak in terms of when is a cost incurred. So you do have to sort of look to this case law to see where judges may fall on sort of that position. So next slide, Bill. The next case here, triple canopy, it kind of has several different issues at play. There's sort of the piece about kind of Afghanistan taxes as we kind of face a withdrawal from Afghanistan. There's the statute of limitations piece, and we'll touch on that a little bit. And then sort of goes back to something Joe said earlier, which is make sure you're reading your contracts, and especially any of those FAR provisions that get incorporated by reference. I know it's easy to sort of kind of glaze over when you're seeing your section I and there's just a litany of different FAR clauses cited, but sometimes that can be sort of the turning point for a case, and that's sort of exactly what happened here. So Triple Canopy had about 6 different fixed price contracts to provide private security services in Afghanistan, and each of these contracts contained FAR 52-229-6, which is, the foreign taxes clause, which essentially stated that a contractor can get some level of an increase in their price, some kind of a price adjustment for after the fact imposed taxes, which can, or duties, which can also include penalties or fines associated with those taxes. But the really important part is there's a subpart I to that, which states that the contractor must take all reasonable action to obtain exemption from or refund of any taxes or duties. So that'll become important as we continue through this. This is a case where the dates are important because this ultimately is a statute of limitations case. And just at a high level reminder, what is the statute of limitations? It just states that, if the government is asserting a claim against a contractor or a contractor asserting one against the government, it must be brought within 6 years of when the claim accrues. And a claim accrues when a contractor or the government knew or should have known that they had some, liabilities or basis for the claim to be submitted. So that 6-year period becomes very important here, especially. So, in February of 2008, the government of Afghanistan issues a directive stating, hey, any company providing private security type services, you can have no more than 500 employees, and then, then you can try to request an exemption for that. In February of 2008, there was nothing about what, any penalties or, any fines associated with having more than those 500 individuals. In August of 2010, the government submits, on Triple Canopy and a couple of contractors' behalf, requests to, for an exemption, because some of, Triple Canopy and some of these other contractors did have more than that number of employees. Fast forward, in March of 2011, that's the first time the government of Afghanistan issues actually an updated directive that states that there will be a fee or a fine associated with any individual above that 500 amount, number. And here initially, Triple Canopy gets assessed a fee of about $879K by the Afghan government. During that time frame, DoD in March of 2011 issued a follow-up letter again requesting that the Afghan government consider an exemption, followed closely by the Triple Canopy requesting in April of 2011 the same type of exemption. And that did prove somewhat successful. In July of 2011, the Triple Canopy receives an update from the Afghan government and denying the exemption in full, but it did reduce the fee in half to about $430K. So contractor on June 6th of 2017 submits a request under that foreign tax clause to make for reimbursement of that $430K because they had gone ahead and paid that assessment to the Afghan government. At this point, the contracting officer did not rule on, issue any final decision, so it was sort of a deemed denial, and Triple Canopy then appeals it to the ASBCA. The ASBCA takes a look at that very long timeline that I just went through and said, okay, Triple Canopy, you knew or should have known in March of 2011 that you could not, you had a claim because that's when they assessed that initial fee against you. And therefore you didn't file until June 6, 2017, you're time barred. You did not file in time. In the appeal to the Federal Circuit actually reversed and really, really focused on that subpart I that I had talked about. It really focused on, Triple Canopy was required per this subpart I to take all reasonable action to try to get that fee reduced, try to get some sort of an exemption. And here they actually had the support of the DoD here. They were submitting letters on Triple Canopy and other contractors' behalf to try to get that exemption or try to at least get the reduction. So in looking at all of this, the Federal Circuit actually ruled, no, your claim didn't really accrue until you had that second, that other filing back from the Afghan government reducing in that fee in half. I will say though, just sort of as a note, July 6, 2011 to June 6, 2017, that's still cutting it a little bit close. So just recall, there can be a lot of different spots where your claim can accrue. And as you can hear from this, it's going to be a very factual and fact-specific inquiry. We're seeing a lot of this in the cost world. We're actually going to talk about 2 other cost cases that relate to statute of limitations issues. It's going to be very fact-intensive, especially in the cost arena where you are incurring different types of costs, maybe over time. You might have, invoices hitting at different moments that could result in a cost. It's sort of a claim accrual. So it is just something to mark and make sure you're really tracking what are the various points when your claim could accrue if you are seeking reimbursement back on something from the government, and make sure you're tracking that closely with both your legal team or whomever you're consulting with, just to make sure you're staying within that 6-year statute of limitations framework. Anything from, I know we're going to also speak quite a bit about sort of the Afghan drawdown and everything a little bit later in the presentation, but anything else from our fellow panelists? Good, great. Next slide, Bill. And, oh, sorry, Bill, I think we went backwards. We're going backwards in time. So Tolliver here, one last one, I promised, sort of in the 2021 timeframe, but did just want to hit on any of the kind of final ones in the latter half of 2021. But here, you know, the contractor here had a contract with the Army, and there was an underlying kind of understanding, and there was a provision in the contract that stated the Army would provide a technical data package. And as they started performance, the Army did not provide that technical data package, but did direct the contractor to go ahead and begin working. Now, later, the Army did eventually remove that provision to supply a technical data package from the contract. But at that point, a relator had already actually filed a False Claims Act case against the contractor here. And the contractor actually had to appeal that entire case all the way up through the Fourth Circuit. So they are incurring a lot of legal expenses. They were ultimately successful in getting that case dismissed. So under FAR 31-205-47, they did try to seek back some of those underlying legal costs. You know, you can try to seek up to 80% of the legal costs back. So they filed that claim to go ahead and try to get some of those legal costs back, and the contracting officer denied that claim, stating that the fixed price contract didn't permit recovery of those costs in excess of the kind of agreed upon contract price. So in an interesting decision, you know, this gets appealed to the Court of Federal Claims, and the Court of Federal Claims, sort of sua sponte, meaning sort of on its own, held that the contractor was entitled to recover under what is known as the Spearin Doctrine. And just very, very quickly, what is the Spearin Doctrine? It essentially states, you know, if a contractor is bound to build according to plans and specifications prepared by the owner, who becomes the government in this instance, the contractor will not be responsible for the consequences of defects in the plans and specifications. So essentially, it's sort of like this implied warranty type provision. And again, this had not necessarily been presented in the COFD. What had been before the contracting officer was that underlying FAR 31-205-47 claim. On appeal to the Federal Circuit, this has now been vacated, the decision, and remanded. And the Federal Circuit's holding here is that the contractor didn't present that as a claim, you know, this breach of the implied warranty or under the Spearin Doctrine to the contracting officer. So the Court of Federal Claims lacked jurisdiction. You might be sort of asking, why are we covering this on sort of the cost slide? But, you know, it's interesting because the underlying case here really is sort of a, you know, -47 legal cost issue that relates to the False Claims Act case. So Tolliver here has sort of gone through the entire Fourth Circuit appeal on the False Claims Act side. Now they also still sort of have this underlying legal cost dispute issue that may need to be, you know, sort of revisited and reevaluated on that front. So there is sort of still this -47 legal cost underlying issue that originated the entire claim to begin with. Next slide, Bill. All right, as promised, we made it to 2022, but in 2022, one of the first kind of interesting cases that came out is this AAI Corp case. And while, you know, we can view this as sort of a statute of limitations case, I think there's also quite a bit on the defective pricing, which we can learn from in this case. And, you know, to Joe and Greg and Ryan's point, since we're seeing a lot more of these defective pricing type cases, it is going to be important to be tracking some of this case law. In this case, Textron had entered into about $87 million with, you know, contract for unmanned aircraft vehicle systems. Then 11 years after the fact, Textron, you know, after it had submitted all of its certified cost or pricing data, the USG issued a final decision stating that they were entitled to actually to up to $7 million was due back due to alleged defecting pricing that they had found via an audit of that survey, you know, the COFD, the cost of pricing data. So on appeal to the board, I think there were 3 different categories really of kind of documents or different types of costs that had, been evaluated as part of an audit of this COPD. So we'll look at each one individually, but at a high level, the first thing the ASPCA stated is that there's really no bright line rule as to when some of these defective prices cases may accrue under the statute of limitations. Logically, you might think, okay, when the contractor signs the contract, that's when, government knew or should have known that it had certain, potentially some of the alleged defective pricing claims. And the ASPCA kind of said that that's not true. There's not really a bright line rule, and it is going to be an extremely fact-specific inquiry for each one of the different grounds. And we'll take each one kind of individually. The first ground was sort of an undisclosed subcontractor bid. And in that one, the ASPCA held that that was a timely, that the government was still timely and could pursue that claim because there was really no way for the government to have known that there was this undisclosed subcontractor bid until they started going through the audit process, which was timely under sort of the statute of limitations period. Now, the really interesting one, I think, is this duplicate shelter costs. So there was this allegation sort of duplication of shelter costs. And this is the one where the ASPCA ruled that hard because they held that the duplication of shelter costs was obvious from the pages of the different documents that the company had submitted as part of its COPD, the cost or pricing data. And the board specifically held that while the cost duplication might not have jumped off the pages on a first read, the government had 6 years to scrutinize it more closely. And then I think this is the key part, it's up on the slide here. Claim accrual is not suspended simply because the government failed to appreciate the significance of what the contractor had furnished. So I do think that's important language to consider as a contractor when you are submitting different types of data during, you're submitting a lot, right? In some of these big contract cases as part of your COPD. So, even though you submit a lot, that doesn't necessarily negate the responsibility on the government side to really look through that documentation, especially, what is obvious from the face of either the documents or the different various, materials you're submitting. I will say, though, in the same decision, there was an interesting piece. The contractor had also submitted labor hours on another project and had done some analysis of that, in relationship to this in monthly reports that it had submitted. And in that case, you could see maybe that the government, the ASPCA might have a similar ruling of, well, it's on the face of the monthly reports. But actually in this one, the ASPCA held that this was still timely and it was not time barred because it was not as obvious from the documents what exactly the issues might have been or, what might have resulted in a defective pricing type claim. And here they really pointed to, the government is permitted to rely on sort of the certification that comes from contractors that they have presented correct documents. But here it would have been a much more intensive effort on the government's part to review some of those labor hours in that documentation. So, overall, I think this is an area we'll continue to see case law, especially as, we continue to see more and more DCAA audits of different defective pricing issues. But it is something to be, keep in your mind, sort of when does that government's timeline start ticking on when they can bring these defective pricing claims against you, and what materials might be or what types of claims the government might bring on defective pricing. Is it obvious from the documents that you've submitted, or is it sort of simply because the government doesn't doesn't take the moment to appreciate the significance of what you provided, that doesn't, negate the fact that they could be time barred down the line. So interesting case, especially in this, kind of statute of limitations area. So anything else from the panelists on that one? I know we're trying to move through the slides, so I'll do my best to keep it going. Next slide, Bill. Real quick on this one, this is a pretty complicated bankruptcy case. It also has to do with sort of the statute of limitations piece, but just at a high level, this is a CAS 413, kind of a pension cost issue, and just really wanted to flag it because we don't necessarily see a lot of CAS issues overlap with statute of limitations, but this is an instance where, we did have a little bit of a complicated fact pattern, and it's just another reminder to contractors that, the statute of limitations applies equally between sort of the government and contractors. But here, the contractor at issue, there was a predecessor company who in May of 2012 initiated bankruptcy proceedings. And as part of that bankruptcy proceeding, they had sort of terminated 3 different types of plans that were at issue. And then the predecessor company's bankruptcy proceeding concluded in February of 2013. So that's an important date, sort of that February 2013. In 2014, Textron acquired the pension assets and had actually purchased some of those assets and liabilities associated with the 3 employee pension plans relating to sort of this entire bankruptcy proceeding. And then, as part of this, in 2018, Textron had submitted a payment demand seeking the government's share of the adjustment amount for all 3 of those pension plans pursuant to CAS 413. And the contracting officer did reject that payment based on sort of the statute of limitations, stating that their claim was time barred. So really, on appeal to the Court of Federal Claims, the judge here spent a lot of time looking at routine versus non-routine type payments, and concluded that a 413 request for payment is not a routine type of payment. This is sort of a non-routine payment, especially when it's sort of in conjunction with a bankruptcy proceeding. And I will say, we don't get a lot of necessarily super fun lines from government contracts cases, but I will say the judge in this case described sorting through all of this case law as a sticky wicket of epic proportions, which might be my new favorite saying ever. But, just anytime you see sticky wicket, it's going to be a good time. But in this one, he did conclude that this had accrued no later than February 2013. And because Textron hadn't actually filed that certified claim until April of 2020, the claim was time barred. And if you recall, that can be a difficult holding to think through, especially since, they hadn't actually finished acquiring any of those pension assets till 2014. But the bankruptcy proceeding and a lot of other aspects of this had concluded in February 2013, and a lot of what had related to sort of the claim adjustment time period that accrued in 2013. So just again, a reminder that even for contractors, we still do face that sort of that statute of limitations running. Next slide, Bill. All right, Ace Electronics. This is, if we're kind of highlighting cases to definitely take a look through, this is one to definitely focus on, especially in this world of COVID and sort of the inflation rules that are, kind of things that we're facing. So in this case, Ace, the contractor, had requested some additional compensation due to increased costs they were facing on a firm fixed price contract with the Navy due to supply chain issues related to COVID. One of their vendors had to increase their price by quite a bit because of all of the different COVID-19 pandemic issues. The amount was about $114K, and then, trying to come up necessarily with the basis for why they were requesting this. Again, they sort of started with some of the COVID-19 pandemic issues, and then also noted that, they alleged applicability of FAR 16203, which has to do with price adjustments due to various, different factors, different variables that may occur. And, in the alternative, they had tried to argue kind of constructive change or issues with duty of good faith and fair dealing. And the ASBCA in this instance did dismiss ACE's claim. And I think the first kind of basis here is a really important one for contractors to be aware of as we're dealing with inflation and COVID and all this. They noted very clearly that ACE's contract did not contain a price adjustment clause. So if the contract, especially the firm fixed price or the fixed price kind of world, did not contain the clause, the board was not going to read that clause into the contract. Now, on the other bases, the government, the board noted that the government really didn't add any additional work, so there really wasn't a constructive change. And then there was no undermining of specific promises, so there was no violation of the duty of good faith and fair dealing. So, takeaway points here, you can see how this may kind of impact both in the COVID world and in the inflation arena. Contractors may be looking for price adjustment clauses or price adjustment type changes. And if you don't have those clauses in your contract, you may be at a difficult position if you're in an appeal to the ASBCA. A board or a court may not necessarily read that into your contract. So it's really important, and I know we'll talk a little bit later about, some of the price adjustment clauses and, ability to kind of add those into contracts. But at this point, we have seen quite a few cases now coming out in the COVID arena, and The boards are really not going to read a price adjustment clause into your contract, nor are they going to find that there was additional work performed by the government if there's not some kind of direction, some firm direction given by the government indicating some kind of a change. So I'll pause there. I'm sure our panelists may have some other thoughts on that case and what they're seeing.
Yeah, and in this case also, the contractor tried to rope in one of the DoD memos on inflation pricing and make the case that they were entitled to a price adjustment because of that guidance, which the court rejected. So I think it's also an interesting read in that perspective, because we'll talk a little bit about some of those memos that have been put out too. But again, that's permissive. The government can do certain things. They don't have to make those adjustments.
Agreed. I think this is a really, really important case in that context, not just for sort of COVID after effects, but also sort of the inflation piece as well.
Yeah, and I don't have anything to add. I agree that it is important, especially from the inflation piece that we're going to talk about. But you're doing a great job, Laura. Thanks.
All right. Well, last slide. In my section, Bill, we made it. You guys survived. Made it through all those cost cases. So this is a pretty recent decision that came out. This is another one where I would highly encourage everybody listening to go back and read not only the ASBCA decision, but this resulting Federal Circuit decision, so you can really compare the two. I will apologize for suggesting you read the ASBCA decision because it is rather long, but these cost principle cases tend to be pretty long. But in this one, I will say overall, this Federal Circuit decision just came out January 3rd, 2023. I will say the ASBCA decision itself that this is based on is not just limited to these two cost areas, but since this Federal Circuit decision focuses on these two, that's what we'll focus on for right now. So the first instance here, is really focused on the lobbying political activity costs. So here, Raytheon had a written established policy that instructed employees who worked in their government relations department to track the amount of time spent on unallowable activities, but in doing so, really focused and considered the time between 8 a.m. and 5 p.m. So that was how they were sort of tracking that time period. DCAA down the line then comes in and questions those costs, and DCMA does sustain that and issues a COFD disallowing them. Now, at the ASBCA level, in its analysis, the board stated that Raytheon's accounting for time paid versus kind of the time worked was a very common industry method, and it was required per their company disclosed accounting practices. It also noted that, there were no necessarily extra costs to the government for that work outside the normal business hours based on some of the accounting done. Now, on the appeal to the Federal Circuit reversed, and it held that Raytheon's incurred cost submissions did not accurately reflect the proportion of time that the Raytheon employees spent on unallowable lobbying. And it looked to a couple of places to make that decision. First, it cited to sort of Black's Law Dictionary, noting that a person's salary under that definition was compensation for work performed on behalf of the company, regardless of when. Then second, kind of took a look at some of the testimony from Raytheon's own employees during the ASBCA decision, and noted that some of the employees had stated that they considered, work outside of their normal working hours to be a regular part of work duties. So as you can see that, kind of look into other sources, and then, there was a conclusion that, there might have been this expectation that regular night and weekend work hours would be factored into the salaries of these lobbyists. I would say there was also a little side piece there of, the Federal Circuit didn't necessarily consider some of the disclosed accounting practices piece because the circuit claimed that Raytheon had not introduced any of the disclosure statements as evidence. But I think at that point, I believe at the ASBCA level, there'd actually just been a stipulation that this is what the disclosed accounting practices stated. So that's just an interesting point as part of the kind of Federal Circuit appeal. But that was sort of the lobbying and political activity piece. So that's one part, and that was reversed. And then you move to the mergers and acquisition costs. And, Raytheon had an established policy here that drew a very bright line in the sand between, you've got a lot of overlapping cost principles that deal with this area of cost. You've got -12, which is these economic planning costs. You've got -27. You've got a lot of overlapping different types of cost principles that can come into play. So Raytheon sort of had a bright line policy to address that issue. And it essentially stated that, unless its acquisition council, its kind of acquisition group that dealt with all of that type of activity, unless the acquisition council had formally submitted an indicative offer, Raytheon considered the costs allowable leading up to that point as, allowable under -12, the Economic Planning Committee cost, the economic planning costs. And then, after that point in time, that would be considered unallowable. And this was, again, a written policy that they had. And the board, initially at the board appeal level stated that that bright line policy was a reasonable reading of all of these overlapping FAR provisions governing organization, economic planning, market planning, selling costs. There are a lot of differing cost principles that kind of can come into play in this area. And on appeal to the Federal Circuit reversed. And in looking at sort of the board's decision, they stated that Raytheon's policies were facially inconsistent with the FAR. In the Federal Circuit's opinion in this decision, they did not see that there are overlap in these cost principles. They stated that, FAR -12 expressly carves out any of the costs covered by -27. So they didn't see that same kind of overlap in between some of these interlocking cost principles. And, it stated that even if they sort of were to accept that bright line policy, they believed that Raytheon kind of snapped the line, I guess you could call it. They kind of, that bright line, they drew it almost too late. They snapped the line too late in the process. It used as an example, Raytheon's policy to charge as allowable costs involved in identifying potential acquisitions, and decided that it found that those costs were unallowable per -27, but they would have been allowable under Raytheon's decision, Raytheon's bright line rule. So there's a lot, and I just said a lot. I know I just monologued about that one for quite a bit. I think there's a lot that this can potentially impact. This is kind of a continuing line of cases from the Federal Circuit opining on cost principles. So I think it is really critical to read this decision because, candidly, a lot of the times, we don't see a lot of appeals, for example, to the Supreme Court. So a lot of the times what we see from the Federal Circuit is sort of that final piece of where we land on certain things. So, I think it is really important to read what the Federal Circuit is saying on this. And there are so many instances where we do kind of, as contractors, draw quote unquote bright line rules to comply with different FAR principles. One I can think of is, companies will sometimes draw a bright line rule of where something moves out of like REA or negotiations versus moving into, all right, we filed a claim, now this is a claim, and any of the legal costs associated with that will be unallowable. There are so many instances where we sort of draw these types of kind of bright line rules just so that we have we can have clear standards for our company. So this is an instance where I know many, many companies who have drawn sort of a bright line rule or just have established policies on, for example, M&A activities. And this may, result in having to go back and just reevaluate some of those, especially in an area like M&A costs and like lobbying and political activities in a lot of instances where you do have overlapping cost principles. Lobbying and political activity, we see the overlap between kind of the compensation cost principle and lobbying costs. And here in the M&A world, there are many, many different cost principles that can come into play when you're trying to develop a rule for your company on when does that M&A activity, actually occur and become an unallowable expense. So I'll pause for a minute. I'm sure my other panelists may have thoughts on this one, but just overall, my advice is go read these decisions because I think it is important to at least be familiar with some of the reasoning, behind the decision itself.
Yeah, and I'll just comment. So when the Federal Circuit enters a decision, authors a decision on one of the cost principles, that's always important. And this is, because they don't do it, it doesn't happen that often. So yes, this is very important. And I think of the ripple effect of how do you comply? How do you adjust if you're a company adjusting your tracking of unallowable costs and your time recorded? How do you adjust things to comply even under this more aggressive position?
Okay.
Okay.
If anything, if nothing else, I will turn it back over.
Okay. So let's go on to the next slide and the next slide. And I'm losing my voice, so I'll be brief. Think in terms of you're a government buyer, and you have FAR 15 gives direction that you can only pay a fair and reasonable price. So how do you determine if a price that you're paying is fair and reasonable? Well, one way is to get competition. So you get adequate competition, and so you can use that competitive forces to ensure that you're paying only a fair price. Let's say you don't have competition, it's only sole source. Well, if it's only sole source and it's over the TINA threshold, the Truth in Negotiations Act or Truthful Cost and Pricing Data Act, if it's over that $2 million currently, that's the threshold. If it's over that, you can get cost or pricing data. So again, if you have to sole source, it's over the TINA threshold, you can get cost data from the contractor. Cost or pricing data require them to provide that. But let's say you're sole sourcing and you're under the TINA threshold. How do you as a buyer ensure that you're getting a fair and reasonable price? Well, again, you don't have competition, so you're doing some type of price analysis by comparing the product that you're buying to some somewhat comparable product. And that can get pretty iffy if you've got a really unique product that you're buying, because it's hard to find something comparable. Well, this is the whole, if you will, and if I'm a government regulator, I'm thinking that's a problem, because even though they're somewhat smaller transactions because they're under the $2 million threshold, but there's a lot of them. The U.S. government buys a lot under the TINA threshold every year, and a certain amount of that is sole source. So I'm mentioning all that to set the context for, remember, in the 2019 to 2022, there was issues with respect to TransDigm, who as a company, they sell a lot of stuff under the TINA threshold to the Department of Defense, and a lot of that is sole sourced. And so they were the poster child, if you will. The DoD IG wrote a couple of reports. The executives of TransDigm were called before Congress. They were all determined to be had done nothing wrong, but it highlighted for the industry this issue of sole source procurement for items under the TINA threshold. So what's the reaction? And so let's go to the next slide and the next slide, if you will, Bill, and one more. These are just some examples of different initiatives that are on the screen right now. The Fair Pricing with Cost Transparency Act of 2022. And then another one, Stop Price Gouging the Military Act from June 9th of 2022. These are just a few examples of initiatives working their way through to try to address the issue that I just raised. I still see this tension in the procurements that I work on, in that the demand for cost or pricing data for procurements under the TINA threshold, and the contractor deciding, okay, I'm just going to give it to them or push back. I'm involved in more and more of those types of debates. And that's all I was going to say about that trend. If there's any comments from the other panelists, I was going to change gears to defective pricing after that. Okay, let's go on to the next slide then. So defective pricing, the DCAA has been, we saw it in the charts earlier, they've been performing more defective pricing audits in recent years, including 2022. They're collaborating with the DCMA and the Office of Undersecretary of Defense in resolving some of these audit findings. As of course, as you probably know, some of them relate more to liability issues that are issues that become more legal and less accounting. And so so that's where the DCMA and the Office of Undersecretary of Defense get involved in my experience. Remember that a finding of defective pricing can be considered a significant deficiency of a company's estimating system or accounting system. So there can be significant ripple effects related to defective pricing findings. If we go to the next slide, just what I'm seeing, and I remember when I first became aware of the cost of pricing data and defective pricing and the Truce and Negotiations Act, I thought, oh, of course, you've got to explain to the buyer how you developed your estimate. And I'll just say that the disclosure requirements, the TINA disclosure requirements, are much broader than just how you developed your estimate. And I find myself training contractor personnel more and more on these issues, where just going back to the definition of cost or pricing data found in FAR Part 2 to make people aware that, yeah, some of the data listed there is accounting data, but much of it is not accounting data. So you've got to think in terms of how to disclose. It's a disclosure requirement, how to disclose the necessary data. And just pointing out one of the other is kind of counterintuitive, is that defective pricing can occur regardless of whether the data that you did not disclose, let's say that data was disclosed that was not current, accurate, and complete, or maybe was not disclosed at all, and it might not have been used in pricing, but it might have been something that was useful or prudent buyers and sellers would typically exchange. And so that's kind of a practice tip. And with that, I'll ask the other panelists if they have anything to add. And if not, we'll move on to the next section. Okay. Cool. So Ryan, do you want to?
I'm sorry, Greg. I'm gonna run the poll again, and just real briefly, if you're interested in CLEs, just respond to our poll. And I apologize for interrupting, and I'll let you get back to it.
Understood. And if we go to the next slide, Bill, that would be great. And then Ryan, did you want to kick this off?
I will. So I think, what we're seeing from a trends perspective in terminations, I think terminations typically spike due to some type of significant event. In 2022, we saw a significant increase in termination settlement proposal work as a result of two events. One, the withdrawal from Afghanistan, and two, the termination of the border wall. Both of those events occurred in 2021, but most of that termination settlement proposal work happened in 2022. Specifically with regards to Afghanistan, the U.S. had $3 billion in obligated but undisbursed funds. So a significant amount of work was still to be done for reconstruction and security. Within Afghanistan, there were definitely specific challenges in helping clients prepare termination settlement proposals. Most of those contractors received stop work orders first, just to see what was going to happen on the ground. Most received full termination, some partial terminations. A lot of that really depended on, could they still continue to operate? Did the agency still believe that those activities were necessary? Did they still have local staff that could implement it? How could they navigate the banking systems? A lot of that work, most of that work has ceased to move forward. And what we're seeing now is some of the unique challenges were access to job sites and project files. Depending upon where the project was, you may not have staff, it may not be safe. If you did receive the documents, typically they're in local languages. You have to translate them for a significant portion of the transactions. And then we saw a number of civilian agencies actually engage U.S. contractors that still had in-country staff to basically serve as the auditors or the technical advisors to the CO And in some instances, they wanted to review 100% of the transactions, which just is not consistent with the termination settlement proposal negotiation. So I think, you want to look at those types of things and figure out how best to navigate them. I think each kind of event brings different challenges that you have to negotiate and work through. And then also, commercial contracts may have been impacted as well with, Taliban takeover. It's essentially a constructive contract termination. Next slide. With regards to the border wall, we did see a spike in termination work in 2022. That was, I think, depending upon whether you were helping the prime contractor or the subcontractor, it proposed unique challenges. The primes were typically partially terminated. The subs were typically fully terminated. But what we've found is that the subs still haven't been paid most of the time, even when they've requested applications for partial payment. And so I think this is the border wall is going to take a while to those termination settlement proposals to work their way through the system. Most of those have already been submitted and are under review or under audit. And then there's definitely some nuances in working with the Army Corps of Engineers about, what specific equipment rates should you use, application of partial payments, et cetera. On a good note, though, with regards to border wall work, we are seeing other opportunities arise that these contractors are bidding on. So in limited circumstances, some of this work is picking up again.
Yeah. Now, I'll just comment before we move on. The Army Corps of Engineers, I think, is unique in that the termination forms are set up to where they can be updated. And so you can submit a termination settlement proposal and then 6 months later submit an update to the termination settlement proposal. And they've, in some instances at least, said that they want to limit the number of updates. So don't anticipate rolling updates as work continues. In other words, they're directing that they not be done in that way. And then the subcontractor issues, are always complicated in my view, in that subcontractor is supposed to submit a termination settlement proposal, which goes to the prime evaluates and fact finds and audits it, and then some amount of that is submitted onto the government for ratification, at which time then the prime can pay the sub. Anyway, that's a lot of stuff to happen. And a lot of these subcontractors are not, this may be the first time they've been terminated, and they're more in the construction space where you don't, in my practice, you don't see a lot of fixed price construction contractors end up having to submit a cost reimbursement. A termination settlement proposal is a cost reimbursement vehicle, or a cost reimbursement is based on cost, and so that's often difficult for these construction subcontractors. Back to you. Back to you, Ryan.
I don't know if Joe or Laura have any other comments on terminations. These other slides are really just I think, background information on termination settlement proposals.
I think if we go to the last commercial contract termination, there was one case to be pointed out on what's meant by a standard record keeping system and how that applies in terminations. And that case is ACLR versus the United States, that came out earlier this year. And in that instance, the contractor had a set of systems that consisted of QuickBooks, Microsoft Outlook, and some other file holders to retain all of its accounting information. And I would say for a smaller contractor that's doing fixed price contracting or commercial item contracting, that may not be outside of the norm from what I would see. But the court found issue with how broad the description of that system was and the lack of specificity in it, and essentially tossed out the contractor's claim because the records wouldn't meet the definition of a standard record keeping system. So again, it's a fairly short read. It's interesting, but if you have clients positioning themselves for a termination of the commercial item termination clause, it's a good reference point to look at.
Yeah, and I'll just comment that I'm seeing that's the commercial item contract termination for convenience. That I used to only rarely see contracts that would have both the FAR 49 termination clauses at 52.249, both those and the termination term, the commercial item terms and conditions. Now it seems routine to where it's like you're all the potentially relevant termination clauses are included, and then it's up to you if there's a termination to figure out, okay, which one applies to this action. So it's more confusing. I guess it's easier when you're drafting the contract to just put in too many clauses, but then when you're actually have to take some action, it can be quite different. So shall we move on to slide? To the slides related to the cost or pricing issues related to the current inflationary environment.
Next slide, please. Great, thanks. So for the past 30 years, the U.S. has really benefited from a low inflationary environment. There's been a couple spikes, 2008 related to gas, and early 90s with the Operation Desert Storm, but for the most part, it's been very low single digits. And during the pandemic, we've seen a significant spike in CPI, the Consumer Price Index. About halfway through early 2021, it started to spike, almost reached double digits about halfway through 2022, and it's still high single digits. And so as a result of these challenges, the DoD and the GSA have both released guidance for contracting officers on how to navigate this with the contractors. And then more recently, there's been additional guidance in the FY 2023 NDAA section 822. Next slide. Okay, so the DoD guidance was issued in May of 2022 and really focused on recognizing the cost increases on existing contracts and the use of economic price adjustment clauses. It's really going to be driven by the nature of the contract type. Next slide. And so from a contract type perspective, the contractor is going to bear the risk on a fixed price contract. The other contract types, there is some sharing of burden there, or shifting of the burden to the government depending upon the contract type. And so the guidance was focused on alleviating some of the hurdles in using the EPA clauses. Who had to approve, what level within the government, how often you could request the EPA clause be used, removing ceilings, things of that nature. And so, it does have, I think, a significant benefit, not only to the government, but also to contractors. From a contractor perspective, you're going to have to be conservative in pricing longer term contracts in an inflationary environment. That may not be advantageous to the government. So the guidance goes through what type of indices to use. The same indices should be used for negotiation as well as executing the EPA clauses. And so I think there's definitely use not only within the DoD guidance, but the GSA guidance that we see out there. And so I want to open this up for conversation. We're running a little bit short on time to see what the other panelists have been seeing in the marketplace with their clients in use of the EPA clauses.
Well, Ryan, tell me if my audio breaks up, but the instances that I have seen for EPA being included is, again, longer lead time items, but then the issue contractors are really having is tying down what specific parts of the proposal really is subject to that cost fluctuation, and then being able to live with potential upside and downside if for some reason prices move in the other direction. So what I've seen from the government is trying to draft those fairly narrowly versus applying to, the contract in total.
And that's consistent with what we're seeing. I mean, the clauses go both ways, right? So if the index drops, then there's going to be potentially a downward adjustment as well. So let's scroll down to the NDAA slides. I think there's 2 more slides. Perfect.
So just as a quick note, I know we're kind of coming up on the time frame, but the NDAA, the National Defense Authorization Act, this all started in October when there was an amendment introduced in the Senate version of the NDAA to kind of allow for adjustments to add in some of the clause language or give contracting officers a little more discretion in adding certain, contract language to allow for adjustments and price adjustments due to inflation issues. So at this point, Section 822 does allow DoD contractors. And what's interesting about the language is, it's both the Secretary of Defense and then delegate down, and then prime contractors and certain subcontractors, covered subcontractors, can actually seek adjustment to their contract price if the cost of performing the contract exceeds the cost price due solely to inflation, and that word solely is in there. It does seem to grant pretty wide discretion. And again, I think what's interesting about this is it does state that, prime contractors may seek that, and then covered subcontractors. So there's different levels may seek, obviously the DoD may amend, but contractors and subcontractors can seek to amend. They can request an amendment to allow for this, the additional adjustment to their contract price. I think a key part is to keep an eye out for the next 90 days because DoD is to issue guidance for implementing that statute within this time period, after sort of Congress appropriate certain funding. And, I think what would be helpful is if that guidance sort of outlines the process and then also what qualifies as an eligible contract. It does give sort of a definition of covered subcontract and eligible contract, but I think it'll be good to see additional guidance on what actually sort of qualifies under those different definitions, and also sort of what the process would be for a contractor or a subcontractor to apply for some of that kind of relief, if you will. Next slide. I think one of the key things is probably that first bullet. There's no actual appropriation of funding for this purpose outlined in the NDAA. And then, I do also think right now it looks like some of the relief contemplated in this area is set to expire on December 31st of 2023. We may see an expansion or some kind of extension based on how inflation kind of progresses this year. But I do think for individuals seeking some of that relief, you may want to consider that date, and just kind of be mindful of if whatever the memo outlining the process, whatever that process is, there may be sort of a deadline on some of that piece. So I will turn any other thoughts from the panelists on the NDAA piece of this.
Well, I'll just comment that this is a very big deal. Maybe it's obvious to everybody, but there's a lot of money at stake. There's a lot of contractors at significant risk. I think I'm impressed. The big primes, of course, that are buying a lot from subcontractors, but maybe even worse is the subcontractor community. So it can be there can be circumstances where they kind of have to file a claim, have to pursue relief one way or another because the amount of money at stake and the implications for the company, profit and loss of the company, solvency of the company can become that significant.
Okay, next slide.
And Ryan, you want to summarize the issues? Or?
I think, just to summarize from an inflation perspective, things people should be considering would be shorter contract terms to mitigate risk, ensuring you include the economic price adjustment clause and negotiated the appropriate indexes to use. incorporate consumer price indexing, et cetera, all of which are there to not only protect the contractor, but the government. And so I think, both parties will probably be looking at this significantly here with persistent inflation. Next slide.
Yeah, so before Alan pulls us, gives us the hook, can we go down one more slide and just talk about the CAS board? So the CAS board has gone dormant. If we were to, we are likely years away from there being a working CAS board. If there are 3 of the 5 positions are currently vacant, there are certain significant matters that are awaiting action by the CAS board, including segment closing pension adjustments, CAS applicability to IDIQ/hybrid contracts, conformance of the CAS and GAAP, the generally accepted accounting principles, and then various revenue recognition and lease accounting. And we can all go into more detail on all the panelists, but just as a practical matter, it's being allowed to languish. And so all of these issues that the CAS board, a working CAS board, could address are not being addressed. So Alan, you're muted. Yeah, that was the main thing we wanted to cover in the CAS area.
Well, I appreciate that, and it came to a perfect end because we're literally out of time. We have a number of questions that were raised. We've captured those questions. We'll try to engage the panel to give us some answers. We appreciate the questions that have been submitted. We've tried to answer some of them. Let me thank our great panel covering such an enormous amount of material, even in the extended period of time available. So thanks to our newcomer, Laura, first timer on this, who did a fabulous job, and our returning veterans of Joe McCaffrey from Baker Tilly, Greg Bingham from HKA, and Ryan Bird from Berkeley Research Group. I also want to thank our event sponsors for their support. We couldn't have done it without them. Their names are on these next 2 slides. And we appreciate their work as well. Thank you and enjoy the rest of the day.